Welcome to the 93rd episode of Kanga Crypto News, your weekly briefing for crisp, dependable updates from the crypto world. I am Kuba, and today we're breaking down the biggest moves from the last 7 days. From ETF rule changes in the US through heavy institutional flows to what's really happening behind Bitcoin recent volatility. Quick reminder before we start. Everything you hear on Kanga Crypto News is researched and prepared by our Kanga analysts using reliable sources only. But this is not an investment advice. We publish new episodes every Friday. So if you want to stay on top of the most important crypto stories, subscribe and turn on notifications. Now, let's get into it. Let's start with the most important structural change of the week. On January 22nd, Nasdaq filed a rule change with the US Securities and Exchange Commission that removes position limits for options trading on Bitcoin and Ethereum spot ETFs. Until now, traders were capped at 25,000 contracts per fund. That limit is now gone. The change was approved immediately under an SEC waiver, with the regulatory keeping a 60-day window to review or suspend it. Why does this matter? Options are the tool institutions use to hedge risk, manage exposure, and build complex strategies. Removing position limits means large players like hedge funds, asset managers, and market makers can now deploy significantly more capital around Bitcoin and Ethereum ETFs. This affects funds issued by names like BlackRock, Fidelity, and Grayscale. More options activity usually means deeper liquidity, tighter spreads, and more efficient price discovery. It also signals regulatory confidence. The SEC allowing this change even temporarily suggests Bitcoin and Ethereum ETFs are increasingly treated like mature financial products, not experimental assets. And that sets the tone for everything else we saw this week. Now let's talk about price action. Between January 25th and 27th, Bitcoin briefly dropped below a key support level, falling to around $86.3 thousand. That move triggered approximately $315 million in liquidations within just 4 hours. Most of those liquidations came from over-leveraged long positions. At the same time, funding rates across major exchanges flipped negative, showing traders had turned defensive very quickly. Bitcoin later rebounded toward the 88-89K, but the message was clear. Leverage is still driving short-term volatility. Zooming out slightly, Bitcoin spent most of the week hovering just below the psychological $90,000 level. Investors remained cautious ahead of upcoming macro signals, particularly expectations around US interest rate policy and broader risk markets. Despite the volatility, Bitcoin is still up strongly on a year-over-year basis, and long-term holders showed little sign of panic selling during the dip. In other words, short-term nerves, long-term conviction. Ethereum followed a similar pattern, trading lower and testing the $3,000 psychological level. Ethereum outperformed Bitcoin during the week, partially due to the weaker ETF flows and the lack of new catalysts on the network side. That said, on-chain activity remained stable and there was no spike in forced selling comparable to what we saw in Bitcoin derivatives. Now to ETF flows. And the numbers here are big. Between January 19th and 23rd, crypto ETFs recorded net outflows of approximately $1.7 billion. This was the largest weekly outflow since November 2025. Bitcoin ETFs accounted for over $700 million of that total, while Ethereum ETFs saw around $287 million in outflows. Interestingly, Solana-based products were the exception, recording roughly $17 million in net inflows during the same period. The takeaway? Institutions weren't exiting crypto entirely. They were rotating, rebalancing, and reducing exposure to the biggest asset after a strong run. While Bitcoin and Ethereum ETFs struggled with outflows, XRP-based ETFs quietly hit a milestone. As of this week, XRP ETF products reached approximately $1.37 billion in assets under management. That makes XRP one of the fastest growing ETF-based crypto exposures outside Bitcoin and Ethereum, driven largely by renewed institutional interest after regulatory clarity in the US. Whether that momentum holds is an open question, but the demand is clearly real. Taken together, these flows tell a bigger story. We're no longer in a phase where ETF launches automatically mean constant inflows. Instead, crypto ETFs are behaving more like traditional financial products. Capital moves in, moves out, and responds to the macro conditions. So what does this week tell us overall? Regulation and infrastructure continue to solidify, especially around ETFs and derivatives. Short-term, market sentiment remains cautious with price action driven by leverage and macro uncertainty. But long-term, institutional access to crypto is expanding, not shrinking. More tools, more liquidity, and more professional participation. Short-term, choppy. Long-term, structurally stronger. Thanks for watching Kanga Crypto News. Remember, always stay informed, and I wish you all the green bars. See you next Friday.
We are Kanga, beyond crypto.